GM. This is the Swing Trading Masterclass, and today on this lesson I'm going to talk about false breakouts and specifically how you can actually use false breakouts to get entries for your swing trades. So in the masterclass I give many different ways to enter, some of them using EMA bands, some of them using retests, high volume breakouts. There's a million different ways you can enter into a swing trade, and the idea is not to use all of them. The idea is to take the different methods I lay out and go and test them on past charts and see what works for you. It has to work both for your eye, right? It has to be something that you can understand visually. Some people like a breakout with a retest. It makes sense to them why something would break out and then retest. Some people like the understanding of a big breakout candle with high volume, and they understand that that may not retest because oftentimes a breakaway candle signals continuation. Some people like to wait until the market has had a big uptrend and then pulls back into the 50 or the 100 or the 200 EMAs. That makes sense to them because those bands are trend following. And 200 EMAs, that makes sense to them because those bands are trend following. And if it's had a retracement, it means some people have gotten shaken out on the way. So there's a load of different ways. The thing you need to remember with swing trading, which is just trend trading, and of course I only talk about it on the long side here, but all of the principles apply on the short side too. Swing trading is just trading in a trend. You're expecting price in a bull market or a bullish trend to break resistance and to continue going higher. Right? That's all you're trying to do. So the entry methods, the technical analysis part, is just a way for you to define your risk and so that you know when to actually pull the trigger. Which coins you choose should be based upon the strength of their trend and of their narrative. It has to be something that the market also likes, which usually can be seen through the strength of the trend and the volume and the market structure. But it's also important to remember that, first of all, we need to be in a bullish trend if you're going to be taking long trades, right? If you see Bitcoin not trending, right? So say Bitcoin's going sideways or going down, or we're in a phase of the market where it's not bull market, it's not bear market, it's kind of in between, it's choppy, it's ranging, it's a bit of a dead period. There's not a lot of interest in crypto. And then you see an altcoin break out and come back to the bands and retest. Understand that that one isolated coin is probably not going to offer a great setup. The best swing trades and position trades come when the market is as a whole rising or falling. You need to have multiple different coins going up or going down. Ideally, the whole market is broadly going up and then you want to pick the ones that are going up more. Or ideally, the whole market is going down in a bear market and you want to pick the ones that are weaker and going down more. Why? Because you're trying to catch onto the train. You're essentially trying to catch the train as it's leaving the station. And when it builds up that head of steam, when it keeps going and going and going, you want to know that there are buyers and sellers coming in, whether it's long or short, to fuel your trade higher or lower. It's always important to remember this. Most people buy something and just think that fucking fairies and Santa Claus with the reindeers comes along and pushes it higher or pulls it up and drags it to the moon. You don't just buy something, wait, and then it goes 100x. From the instant you buy, other people have to do all the work. If your plan is to buy people have to do all the work. If your plan is to buy once, do nothing, come back and get a 5x 5-hour trade, what happens in between? Have you thought about that? You need to think actually about it. What actually makes the price go from where you get in to where you get out? It has to be, in a long scenario, it has to be an overwhelming amount of buying from other people that is stronger than the selling from the bears, right? And so the best way to do that is to wait for optimal conditions in the market. That is why most often the market waits for Bitcoin first to have a big move, because that signals to the market, okay, Bitcoin's on the move. Now we are going into a risk on period. And now we can start to run these alts up, because if I then start to buy my alts, I know other people are going to come in and buy, because everyone wants to buy something that's going up. And then as we go on and on and on, people come in and buy more. And then all the bullish announcements of the team come out and all the other shit that comes along, and everyone starts shilling it on Twitter and on YouTube, right? You've got this whole cycle of liquidity, but it has to start in a positive liquidity environment for longs or a negative liquidity environment for shorts. So if you're talking about the short side, bear market, that's when you see things like mass liquidations. Liquidations are excellent if you're in a short, because the market is literally forcing itself downwards by stopping out a bunch of other people, and you're just catching along for the ride. And in periods of excitement is the right word, not euphoria, periods of excitement, of hope, of general optimism, that's the best time to be long in a swing trade. Too many people psy-up themselves by saying, as soon as something goes up and they see other people happy that it's going up, they think, oh, it's the top, everyone's euphoric. No, you have to have sustained periods of optimism and hope, because people have to literally come in and say, I am willing to buy this because I think it's going to a higher price. If you don't have hope, if you don't have optimism, the market will not go up. Think about it. You only buy because you think that the market's going to go higher. Therefore, you must have an element of hope or optimism, right? You've optimism about the next Bitcoin narrative or the next whatever happens with your altcoin. So you also want to have a good idea that the market also thinks that. Now, false breakouts are more and more common in 2023, 2024. They're going to be more common than ever. They happened in 2020 in the last run. They happened in 2017. But they've been happening for years and years and years. Now, if you actually go back to the stock market in the 70s and into the early 80s, breakout trading was just being pioneered. It was pioneered predominantly by a guy called Richard Dennis, who made millions of dollars from a very small stack, from thousands up to hundreds of millions, from just trend following breakout trading. Now, it wasn't as simple as that, of course. There was more nuance to it. But it was not based around anything to do with false breakouts, because false breakouts broadly didn't happen. The market back then, believe it or not, used to consolidate. Right? It used to go sideways in a range, in a compression, and whatever. And then it would push up and it would break out. And as long as there was high volume on that breakout, it would actually just continue. It would keep going. And as I said, he made millions and millions of dollars until the 80s, where it all fell apart because of the advent of program trading through computers. And it meant that it was extremely easy to replicate systems like his, and it lost edge very quickly. But does that mean that markets no longer trend? Well, obviously not. Take one look at any chart and you'll see that markets do trend. And since the goal is just to get a market to go up and to be on board, then obviously there's still ways we can make money, even if just straight buying every breakout doesn't work. And that is true. Now, though, it's much trickier because you have false breakouts. Often you have multiple false breakouts. And often, very, very common, you have valid, fully valid breakouts with high volume, candle closes. You know, you look at it at the end of the day, you're like, this has broken out. And then the next day, 2 days later, boom, it's back down below the lows. That is a feature of the market, because the most basic thing you can do in a bull market is to just buy when it makes a new high. The most basic thing you can do in a bear market is to sell when it makes a new low. This is so easy, you could get a baby to do it. So obviously, a strategy that is just that is not going to work over time. For traders, okay? In a bull market, if you're an investor and Bitcoin makes a new high and you just buy some and you're, earlier in the bull market and you buy spot and you don't sell it, you will actually end up ahead. But of course, as a trader, you might buy a breakout at 40 and then it drops back to 38 and stops you out. Then it goes down to 36, comes back up, goes to 41. You buy that breakout, it comes back to 37. You get stopped out. Comes back up to 42, you buy that one, it drops back to 39, stops you out, goes up again, breaks out at 43, you buy that one, and away it goes, it doesn't come back. So you have 3 losses, and then you get a winner. But the person who just buys spot on every breakout has no stop loss because they're just investing. They're averaging in and they're saying every time it makes a new high, I buy some. They don't get any of those stop outs, they wait much longer, and they end up in profit. So you have to understand that as well. What you're trying to do is trade. Trading is entry, stop loss, and a target, generally. It's risk defined. So this is totally different to your longer term bags. If you've got most of your portfolio in spot, which I recommend, you should either buy high volume breakouts, just spot, whenever it's low. Okay, you don't want to be buying the high volume breakout after all time highs. But if you see a high volume breakout that comes along after a lengthy consolidation, you can just buy that with spot because you're supposed to buy stuff that's going up. The other side, the other way to do it, is to wait for a large uptrend. So wait for the big breakout, wait for price to continue, then wait for it to decline, usually for several weeks. And depending on the coin, if it's Bitcoin, for 20, 30, 40% correction. For an altcoin, that could be 50%, and then buy. But in both cases, you're buying strength. You're buying the strong breakout when you consider when your methods tell you that it's early, and you buy the pullback after a strong breakout whenever, again, your methods tell you that it should lead to a continuation. That's spot. All right, so spot's much easier, and that's what most people should do with most of their portfolio. But for trading, we need to get a bit more tactical about it. So we'll talk today about false breakouts. Meaning, how do you know when a false breakout is actually bullish, not bearish? And I'm going to obviously focus this on the long side only. Short side, you just invert the chart and trade it the other way. So how do you know when a false breakout is actually going to pull back, because it is going to be a